Hello and welcome to World Talks here on TVP World with me, Ashim Kumar. On Tuesday, the International Monetary Fund slashed its forecast for growth in most countries, including the United States and China, citing the impact of US tariffs and warning that further trade tensions would slow growth even more. The IMF released an update to its World Economic Outlook, compiled in just 10 days after US President Donald Trump announced universal tariffs on nearly all trading partners and higher rates, currently suspended, on some countries. The IMF projections, which incorporate some but not all new US tariffs, anticipate global economy growth at 2.8% this year. To share his analysis of the impact of tariffs is Professor Iain Begg, Research Fellow at the London School of Economics and a regular contributor. Professor, welcome back to TP World. Thank you for taking the time.
Pleased to be with you again.
Good to have you, sir. So before we kick off, there's a short video clip I'd like to share with you, and then I'll get your take on it.
We are seeing the risk of a recession happening in the US as an increased risk. We are, according to our calculations, that risk has increased from about 25% back in October to a little bit, almost 40% now. So that's a significant increase.
Significant indeed, 25% risk of recession a few months ago, and now it's 40%. Would you agree with that evaluation?
Well, certainly I'd agree with the direction of change. The trouble with these kinds of forecasts is you're saying, will it be down to 0.3 positive or 0.1 positive or minus 0.1? And the difference between these is, in practice, insignificant. What's absolutely clear is that there is going to be a slowdown or a drift into recession, and the magnitude of it is what should concern us rather than whether it's defined as recession or not. What's the magnitude in your view? Well, there's no certainty around when you're talking about Donald Trump. In fact, the only certain thing about Donald Trump is that it's going to be uncertain. He could change his mind radically in all sorts of things. He seemed to bow to the pressure from the financial markets when he first released his ideas on tariffs and then said, no, they're suspended for 90 days because the markets crashed. The markets crashed again yesterday when he threatened to fire the president of the American Central Bank, the Federal Reserve, Jay Powell. So these uncertainties are the things hanging over as much as the specific actions like tariffs or his attempts to oust to the Fed chairman.
Yeah, which he can't do, can he, unless, as I understand it, unless there is cause, but it's not within his power to actually fire the chairman of the Fed. But clearly his words are still having an impact. Now, I'd like to move to US Treasury Secretary Scott Bessent. Who is this man and how does he fit into what's going on? Is there something he can do to steady the ship?
Well, he's not a billionaire. There's a lot of them around in the White House at the moment. He comes from Wall Street more than anywhere. He's being portrayed to some extent in the media as the grown-up voice in the White House trying to calm things down. But once again, you never know, because he could be saying things in the background and they're being swept under the carpet or ignored by Trump. Everything in the end boils down to what Trump decides. So although Scott Bessent may be trying to say, calm down, don't engage in these dramatic effects, be aware of what's happening to the dollar, be aware of what's happening to the potential for the dollar holdings of other countries to be dumped on the market. What we don't know is whether he has real influence when Trump is in full steam.
Understood. Now, one of the, well, you mentioned the spat between Trump and Jerome Powell at the Fed. Trump wants Jerome Powell to lower interest rates, and Powell doesn't want to do that. What's the thinking behind each of those views?
Well, the thinking on the Fed side is that it's had a long-standing independence from government interference, And any chairman of the Fed or even any employee of the Fed will want to preserve that independence because they see independence in monetary policy as being both economically and politically desirable. As you know, most European countries now have independent central banks. The European Central Bank is independent from direct political control. It's a movement which was based on governments interfering in ways which were counterproductive and caused higher inflation. So that the preservation of independence is something Powell will be very keen to maintain. It goes back decades. Trump's point of view is interest rates are too high, and he wants to lean on the Federal Reserve to lower interest rates. The Federal Reserve, on the other hand, says there are now risks to inflation, not least from the arrival of tariffs. Inflation hasn't fully abated from the surge it had in the last 2 or 3 years. Therefore, they want to be cautious on interest rates until there's a more settled view. You can't have both these things.
Understood. Now, is there something that other financial institutions around the world can do to stabilize what happens to inflation and interest rates and so on?
Well, other central banks will be making judgments based on their understanding and interpretation of their own data. Just last week, the European Central Bank cut interest rates again and seemed to think it was a necessary thing to do faced with a stagnating European economy. Same applies for the Bank of England, which recently cut by 25 basis points, 0.25% of interest rates. So all these independent decisions will be being made. The IMF, which, as you mentioned in the introduction, is having its spring meetings at the moment, is the institution which tries to oversee the macroeconomy of the world. And it's cut its forecasts. Therefore, you might think that would lead to lower inflation. But tariffs have a perverse effect because they raise prices of goods that you import, and that will come out as measured higher inflation. The IMF will want to be very cautious because it depends very much on American goodwill. And as we know, it doesn't take much for Trump to throw away all the goodwill and think, no, I'm going to attack this institution rather than play along with it. So the IMF is going to be very cautious. I think you saw that in their chief economist's clip that you showed, where he said, we think it's a higher probability. Probably behind the scenes, he is saying, this looks bad. We'll get in for a worse time.
Well, you mentioned the IMF again and Trump's and their reliance on the United States. Now, of course, Trump. There have been rumblings that Trump isn't particularly happy with the IMF and the World Bank, and threatening perhaps to pull out. Do you think he's simply playing a game here, or is there a real intention, in your opinion, to do these things?
As always, it's very hard to tell with Trump, but he's already pulled out of the World Health Organization because he no doubt blames them for the COVID epidemic. He's pulled out of UNESCO, which he sees as being too full of lefties. So there's already a track record of Trump pulling out of international institutions which lie behind the global economic order, which he's doing his best to tear up.
Now, Managing Director of the IMF, Kristalina Georgieva, said last week that the World Economic Outlook's growth projections will include significant downgrades but not recession, largely due to uncertainty and market volatility. A little bit more optimistic, perhaps, than what we heard a few minutes ago. Do you think there's grounds for her? Are there grounds for her to say this?
Well, remember, she's looking at the world economy, which includes China, includes fast-growing countries like India or Brazil. So they're averaging out across countries. But what's clear from the IMF projections is that they now expect lower growth just about everywhere than would otherwise have been the case. Hence, the world growth rate this year dropping to 2.8% from something like 3.5% in the previous forecasts. But when you spread that out amongst the individual countries, you will see some which they're projecting now to go into recession, some which are going to stagnate plus or minus zero, to put it in almost silly terms.
Right.
So we don't quite know what the detail is, but once again, it's the direction of change which is critical. It's looking worse than it was as recently as 6 weeks ago.
Understood. Now, with this turmoil, of course, as you said, the markets have reacted, and with many currencies, including the dollar, going downwards. But the one winner, if you like, has been gold. What do you make of that? Why are people putting their money into gold?
Well, the first answer would be putting money into gold is illogical because it has no trading value other than to other people that want to buy gold. But the simple answer is also that they see gold as a safe asset. If the dollar is depreciating, possibly because countries like China and Japan want to dump their dollars and therefore drive down the value of the dollar, an alternative is to hold gold, which is a scarce resource and might be a better way of storing your wealth, even though gold pays no rate of return, in contrast to currencies which do pay a rate of return.
Right, so we expect, hopefully, when prices stabilise or recover, gold price to drop again as people kind of reverse this, do we?
Economists learn very early on not to predict exchange rates or gold prices because you're in a fool's errand there. So, yes, logically, if the dollar recovers, the gold price ought to go down, but I wouldn't want to bet my own money on it.
All right. Well, we'll see what happens. Now, you mentioned the other big economies, China and India. Is this an opportunity for them perhaps to exploit at the moment?
It's an opportunity in the sense that the Chinese will be looking at their trading patterns and thinking, it looks as though we're being frozen out of the US market. Where else can we sell? And the answer is going to be in Europe, in what we used to call the global south, those countries which are emerging markets or developing markets. But it's not something that happens overnight. And China is well known to take a long view in all these things. I'll be thinking, how can we start to recalibrate in a way which means that we don't take too much pain now, even though we can endure that pain, but hope to prosper later. And some of the things that Trump is doing, for example, freezing out the supply of Chinese components for various products, are things that in the end might actually work to the advantage of China because they will then develop indigenous industries to use these things rather than rely on American demand. So there's a big reconfiguration going on. And while that reconfiguration is going on, there will be market turmoil. But we need to look 2, 3, 5, 10 years down the line to get a sensible picture of it. And maybe one thing to bear in mind is the number 45. That's the number of months that Trump has left in power unless he subverts the American Constitution.
All right. Well, we shall see how the Chinese economy and others, of course, respond to these tariffs. But in the meantime, Professor Begg, I'd like to thank you very much for coming along and sharing your analysis with our audience. Have a good day.
Same to you. Thanks.
Thank you. Bye-bye. And that's all from us in this episode of World Talks. Goodbye.